Welcome, I'm Catherine Magana here with Steve Wolf, Greg Carroll, and Vince Stefano, where we're here to provide insights about the markets and investing and some planning. So here we are a couple weeks out. It's been a few weeks since we've been together, and the market just keeps going up and up. My goodness, we're hitting some new highs again. Looks like the Dow is up over 5%. NASDAQ's over 24% year to date. The S&P 500 up to over 18%. And the Russell 2000 up a little bit, up over 1%, and this is as of yesterday's close of July 10th. So, goodness, I mean, the markets seem first half of the year, we're in positive territory. If we can just stay this way between now and the end of the year, I think we'll all be happy.
Well, I'm gonna come in and start saying a couple of tidbits, but a lot of the Wall Street economists and soothsayers that look into their crystal ball have now started saying that there's a lot of uncertainty in the market going forward. A lot of it's driven by the Fed, a lot of it's driven by AI, a lot of it's by the presidential election coming up, and second quarter earnings. There are a number of these economists, Morgan Stanley, Goldman Sachs, JP Morgan, that are now calling for a possible 10% correction in the market between now and the end of the year. They're saying that, one, because the S&P has been hitting all-time highs, and I think we've had 34 all-time highs this year. And secondly is that they continue to think that the Fed is going to cut interest rates. And yesterday, Jay Powell may even said, well, we may not wait until we get to 2% inflation before we start cutting rates. The big question is now, as the market begins to right now the market, the path of least resistance is up for the market. But if it does start to decline, how much ammo is in there for people to start buying on the dips? And that's going to be a really big question. And one more thing before I turn it over to my colleagues. I saw this the other day, and I think I wrote it down correctly. Bullish sentiment right now is at 42%. Neutral is at 32 and bearish is at 26. And I think you had, Steve, some numbers early in the year where bullish was much higher than that. So the whole sentiment is starting to kind of tick down a little bit. So, we'll see. I think that the market is ripe for a bit of a correction. August is always one of the worst months of the year. So, keep your hands and feet inside the ride.
It's rare that that a year goes by that there's not a 10 or 15 or even 20% correction. We all go kind of crazy. Oh my God, the sky is falling, but that's normal. So, especially after a big run up, if we have a correction, I almost think that should be expected. It's what will happen with the big tech stocks, because that has been what has dominated the index. The S&P index, the NASDAQ index. So if those things start going down, you'll see a correction.
I think there's also times there's intra-year where the markets actually are down and then we end up positive in the year. And so as looking back in 2021, at one point the S&P 500 was down 5%, but at the end of the year we ended up 27%. And then in 2022, intra-year, S&P was down 25, it ended up down 19. And then in 2023, the S&P 500 intra-year was down 10%, but ended up 24%. So once again, we're looking at 34, 50% moves within a year. And so, yes, there are times that markets pull back and correct. And, obviously you just have to hang tight and make sure you're in a good allocation too.
And, the presidential election could have a short-term effect on the markets. It does not have a long-term effect. Matter of fact, I think that's what we should do. We should do a special on presidential election years. But, it'll be interesting if Trump wins to see, what happens to the market, or if Biden wins, what happens if it just continues to go the same. But again, I think you'll see that in maybe a 1 month period, maybe November, December type thing.
Yeah, I think, one of the other aspect to all these tech stocks doing, they're growing their earnings, driving this market, continually setting new highs, is the consumer, who has been very resilient since COVID. It appears they're kind of spending all that free money. They've kind of run out. Credit card debt is at all-time highs, $1.3 trillion or something like that. So interesting. I was reading this report the other day about the labor market and how strong or weak it might be. Last Friday, which would have been for the June report, came out with another great non-farm payroll. It was up over 200,000 jobs. another very good month. But when you look at the downward revisions the prior 2 months, because they always give your initial report and then revise it twice, if you take that out of the total, the payroll was only up 95,000 jobs. And it was only 50,000 from the private sector. So the government put a lot of jobs into that.
Now, which is not exactly where we want to see the growth.
No, exactly. And then also, one of the stranger parts is over the last 12 months, non-farm payrolls are up 2.6 million jobs over the last year. But civilian employment, which is an alternative measure of jobs, which includes small business startups, is up a grand total of 195,000 jobs for the year. Not 195 per month, for the whole year. Kind of weird, right? Another oddity is the consistent negative revisions. Like we just said, you get an initial report and then 2 revisions. The past couple of years, this has kind of been a theme. Back in 22, the third report for payrolls averaged minus 6,000 jobs per report. Not too bad, but in 23, that number was up to minus 30,000 jobs. And year to date, it's 49,000 jobs revised down. You know, we are coming into an election season, so maybe there's some narrative there, but you know, I do think it's also odd when you look at if we are producing all these jobs, yet unemployment's going up. We went from 3.4, we're at 4.1% right now. You wouldn't think that unemployment was going up when we're creating all these jobs. So something's going to give.
Are you saying that the government would actually lie, or what?
I just think they look at numbers a little differently sometimes than we would look at them. So, but you know, so if the consumer is starting to weaken some and they're accumulating all this debt, maybe we are going to slow down a little bit on the consumer side. The question is, you know, do these titans continue to grow their earnings to support the markets?
Well, interestingly, I mean, we talked to one of our clients who may be looking for a new job in the tech area, and he said it's not as easy to find a job today as it was a year ago.
Right.
So that leads me to believe that the companies are not hiring, and if anything, they're probably firing people.
Yeah, I think you know, it was so hard to find people willing to work back during COVID or shortly after COVID, right? Because they're getting paid so much just to stay at home. Mm-hmm. I think employers probably kept people on a little bit longer than they normally would have because it was so hard to get them in the first place. But now, yeah, I think that you know, we are slowing down, and you know,
COVID seems like it was years and years and years ago. This is just like 3 years ago, right? Feels like it was 20 years ago. I mean, how many people do you see walking around that have masks on today?
Very few.
Not many, but the few that do, you kind of give them an odd look. But just one more thing.
But the few that do are now actually robbing the banks.
That's true. And I don't want to. I just want to touch one more thing on Steve and your tech stocks. What we're starting to see now is interesting. We're seeing more valuation downgrades of technology stocks. And we're seeing that because typically when they have a huge run like they've had and they hit certain price targets that sell-side analysts have put on the stocks, unless the stocks are going to go up another 30 to 40% from their current price, the analyst is typically required to downgrade the stock. And that's typically what happens at these big sell-side firms. So you're seeing valuation downgrades. You're seeing them increase the price targets, saying long-term fundamentals are still good, so any weakness, buy, which means they're going to start upgrading the stocks after they come down about 10%. So, keep your powder dry, and there's going to be a lot of opportunities.
Well, and tech stocks may go down further than 10%.
Yeah,
they're pretty volatile. I mean, I could see in one day some of these are coming down 10%.
But what I'm saying is that all I'm saying is keep your powder dry, because there'll be some great opportunities if some of these tech stocks do go down.
Yeah. So what you're saying is buy when it's down.
Oh, absolutely.
See, there's a new phenomenon. Buy low and maybe sell high.
I'm going to throw one more thing out there. And I read this in the Wall Street Journal. They were talking about, and this is from I'm not a real estate expert, but I did read this where they're saying the real estate market could be in for a major correction like the stock market due to high interest rates, low inventory, and nobody's leaving their current home. So I don't know where that's going to go, but hey, keep talking about that.
Well, if interest rates come down, I think there'll be more of an incentive for people to go elsewhere. But when you're locked in a 2.3% mortgage rate, it's a disincentive to move from where you are.
I think it's kind of odd that they said it was low inventory. That's supply and demand. If there's low inventory and people want to buy a house, that's going to support the prices. The high interest rates is going to deter some people, and refinancing is not an option for most. So
they're just
that's interesting.
I'm just saying what I read in the journal. No inventory, high interest rates, and higher prices.
Okay, well, Vince, both Greg and I believe that you're wrong, so we'll see what happens.
It's interesting. We actually have a client that we're working with. They are about to inherit some money, and through the process, there were some outside accounts that the family had, and there was a house, but nothing was titled properly. So everything is going through, a lot of it's going through probate. And so what came up in the conversation was, as everything gets divvied up, they're going to get their portion, but we're really reiterating that they should get a trust, and their whole family agrees. Yes, we all need to look at getting trust. And once again, it's kind of case by case, but you definitely should work with an estate planning attorney. If you don't have a trust in place and your assets aren't titled properly and it goes through probate, it could cost a lot of money. It takes a lot of time. And if you have a trust in place and everything's laid out, it could avoid probate. It goes a little smoother. A lot of times, everyone thinks, it costs so much money, but the reality, it costs a lot more money for the estate if you have to go through probate. So there's some, we're not estate planning attorneys, but we do look from a financial planning perspective. Are your assets titled properly? Do you have a trust in place? And if you don't, definitely talk with an estate planning attorney in your area or in your state. And then the other thing with the estate is if you do have a trust, some of the things we see occasionally are your assets titled in the trust? So are your properties titled in the name of the trust? Are your investable assets titled in the name of the trust? So that's something, if you do have a trust, to make sure that everything is in order.
And speaking of keeping your money before you die,
yes.
I came across something from savings.com about how parents are helping their adult children. And according to this particular article, there are significant risks in extending long-term financial assistance to adult children. It's really simple math. This article says parents in their 50s and 60s that are helping kids in their late 20s through their early 40s are endangering retirement planning, saving for long-term care, and likely trimming inheritances too. So it's kind of interesting. The survey said, I feel like I'm on Family Feud.
Ding, ding, ding.
The survey said 47% of parents with grown children provide them with some form of financial support, not including adult children with disabilities. Apparently that was done this year, and apparently that hasn't changed much from last year. And certainly there's validity in helping an older child have the resources for a down payment on a house or giving them money for their grandkids' education. But Savings.com says many respondents are not being as prudent. It said, Savings.com said 46% of parents who financially support adult children give them money for vacations and discretionary spending, and 18% help their adult kids pay off their credit cards. I don't know. I've got to the point with my kids that said at some point you're on your own.
That's a teaching moment.
It really is.
Yeah.
And it says among the parents surveyed, the median age by which they thought kids should be financially independent was 25 years old. Despite that, many are still supporting children well over that age. Of parents providing support, 21% were helping millennials, and that's ages 28 to 43. Or Generation X, which is ages 44 to 59. So folks with children in their mid to late 40s are likely well into their 60s and 70s, implying that many aren't even working, and they should be prudent with their spending, not necessarily helping their children with vacations and paying off their credit cards. So, yeah, it's hard, and we talk about this all the time. They're our kids. We want to help them, and we all want what's best for our children. But at some point, what's best for the children, I think, requires some tough love and say, hey, you racked up that credit card bill, you pay it off.
Well, yes. And what's the impact for you as if you are helping your children at the end? Are you going to have enough later to cover your
And we've seen that, right? I mean, we have this nice financial plan that we put together, and then all of a sudden, hundreds of thousands of dollars are going out for children, and then the parents, they're dwindling down their retirement assets, and sometimes they may not have enough for themselves. Now, I'm sorry, but that doesn't make a whole lot of sense to me.
That'll throw a wrench in a good plan there. But so I guess we have to, bring that up with these financial plans and say, how financially stable are your children? Mm-hmm. Are they 20 years old? Are they 30 years old? 40? Are you helping them out?
And also maybe for a lot of people, I think the children should be involved in the financial planning of the whole family. And I know there's a lot of parents that don't want to do that. They don't want to reveal perhaps what they have or what their plans are. But I think that's a really good idea for financial plans. What do you think, financial planner?
Well, I think anytime you can educate and help kids any age learn is really important. And yes, if you can have even adult children involved in the process, I absolutely think that the more engaged they are, then they're going to have their own plan as well. It's interesting, in California, there was a bill signed by Newsom, AB 2927, that is requiring financial education for young kids. So starting in 2027 to 2028, they're going to offer financial literacy courses, and then graduation requirement in 2030, 2031. So if we can get to the kids early.
So until 2027 or 28, they should be financially illiterate?
No, they can learn, but at least now this is a requirement that's going to be here in California. This is across the U.S. We're the 26th state now to require high school students to take financial.
I can't tell you how important that is. We need to teach our children about capitalism because they get to college. And the only thing they've really seen are, I will have to say it, kind of socialist policies, and don't understand the advantages that capitalism really gives to you. And they know nothing about it. There's many, many times that we will have prospects who actually have made a lot of money that really don't understand the economy and don't understand how our system works. So I think that is extremely important, but it's even more important as to what it is exactly that they're teaching them.
Correct. Well, this is a start, and so I think we're getting in the right direction, but yes, there's still a curriculum that has to be built out, at least here in California, but I definitely feel, I've been doing advocacy for many, many years, and this has been on our radar for a long time, so I'm really happy to see at least we're moving in the right direction.
Just seems like bureaucracy goes so slow in government. Yes. I mean, if it's good, 5, 6, 7, 8 years from now, why not today? Like Steve said earlier, there's programs built. There's a lot of things they could just plug and play in the schools tomorrow.
All right. Well, speaking of words of wisdom and financial literacy, we'll be back next week about this time. Until then, have a great week.
Thank you.
Thanks.
Bye.
Please stay tuned for important regulatory disclosures. WWM Financial is an SEC-registered investment advisor. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry and how we may be able to assist. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. As always, please remember, investing involves risk and possible loss of principal capital. Tax considerations presented may not be appropriate for every individual circumstance. A tax professional should be consulted before making any decisions about your tax liability.